Hello, David Moore with Equity Advantage, along with Robert Smith of Peregrine Private Capital. And this segment, we're going to talk about diversification. So I think, originally you were just a just a Wall Street financial advisor, and then you had joined the dark side into real estate and went in the DST space. And we'll talk about that another time, what the catalyst that move was. But when we talk about diversification, any financial advisor is going to tell you the secret to success, safety is diversification, and typically they're talking about that menu of items on the Wall Street world, and we're talking about I like to say real estate's the real investment, tangible asset, ultimate inflationary hedge. And if we're talking about diversification, obviously you're going to go Wall Street out of Wall Street too. But if we start looking at real estate to diversify your holdings, it's possible with the products you sell, not only to diversify. We talked a little bit about companies earlier, but all kinds of different asset classes and loan to values too. I mean, so diversification from your context, would look like what for somebody?
A diversification would be both physical or geographic and functional. The three top performing commercial property types in terms of total return in descending order. Number one is self-storage, number two is senior living, number three is industrial warehousing, and number four is multifamily. And so again, in as fully priced an environment as we are in, the chief strength, the best thing we think that DST brings to your table is your ability to diversify not only functionally but geographically, taking all your eggs, a lot of eggs, out of one basket and putting them into multiple baskets geographically and functionally. It's certainly not perfect, but it should significantly improve protection against loss of investment principal if you can diversify fully. And the fractional nature of DST ownership allows you to do that more easily than anything else. So a well-diversified portfolio is probably, and again, it's to a certain extent it's opportunistic because the DST property universe is changing all the time, and in 1031 exchange you have a limited amount of time in which to do your exchange. So you are limited to what is available in your window, but a diversified portfolio would be diversified functionally over different asset classes as well as geographically.
So if we look at different offerings, and a lot of these people are coming to you because they're tired of the terrible teas, right? Toilets, trash, tenants turnover. They can't deal with what's been put out there from the government's perspective anymore. And so, a lot of times they're looking at different assets. Maybe they give up an apartment building and somebody says, well, hey, you ought to buy a 10-minute oilery or buy Walgreens, a nice big single tenant, big box, which while they're working is a beautiful thing. But if you got 40,000 feet that goes dark overnight, that can be problematic and at best. And then you got the banks calling, hey, you're out of compliance, you don't have it leased, and da-da-da-da-da. And anyway, so any comments to that effect along those lines with respect to something like that?
Well, we mentioned earlier that we've been emphasizing operating assets, multifamily, senior living, self-storage, manufactured housing for quite some time, to the exclusion of single-tenant net lease assets for that very reason. One thing that many investors don't understand, and because their brokers don't understand it, they are not capable of explaining it to them. Operating assets and single-tenant net lease assets are priced in a totally different manner. Operating assets generally are priced on rental income stream, meaning if you buy that building and it is cash flowing at X, and over the ownership interval your management is able to increase rent to 2X, there's a strong likelihood that is going to be reflected in some type of gain in equity at time of sale. So you could say that time works in your favor from an ownership standpoint with operating assets, where the reverse is true with single-tenant net lease assets. Single-tenant net lease assets are priced on the lease, the duration of the lease. And so you can make an argument that a single tenant net lease asset is never worth more than at the very beginning of that lease, because the longer you hold on to it and the more of that lease you burn off, generally speaking, the less the asset is worth, because then whomever the next buyer is going to be then has to deal with releasing. Okay, I've got Walgreens. Is Walgreens going to release from me? And if I've got to refinance, I can't get refinancing from the bank until the tenants re-up with me. And then all of a sudden the whip hand changes from the landlord to the tenant. And with way too much in the way of bricks and mortar retail for the digital age, and every year after year, there are a smaller number of tenants occupying that space. That's a recipe for rents going down, not rents going up. And that's something that a lot of investors don't understand. And when it comes time to sell a single tenant net lease property, they don't understand why they're not seeing more appreciation on the back end, because the broker wasn't bright enough to explain it to them. And the two asset types are priced very differently, and you have to understand that. As David mentioned, do they pay well? Yes, they pay well. There's usually a premium on retail assets from a cash flow standpoint because it's a problematic asset class, and institutions are averse to that, okay? That being said, and they are backed up by Fortune 500 balance sheets, so they provide a very good cash flow. That being said, we tell our investors who absolutely positively have to have retail assets that you should look at that elevated cash flow as a partial return of investment principal, because the likelihood of getting all of your equity back when that is sold, let alone an increase, is pretty slim. So they're priced very differently, and it's very important to understand that.
So when we're talking about, for example, the old institutional real estate offerings were primarily all tenancy in common. And today, the people that use tenancy in common structure, the sponsors, are typically value-add assets.
Right.
Assets, a single asset for the investment, where DSTs, how often is a DST offering a single asset?
When DST started 20 years ago, it was usually one program, one property. The products matured very, very nicely. For internal diversification's sake, there are very often now multiple properties in a single DST offering. They're property type specific, meaning we're just finishing up a single DST, but it has 15 self-storage properties in it, diversified over 6 different states, 3 of which are no income tax states. That's a good thing. Okay, and we have been multiple family offerings with 3, 4, 5, 6 apartment properties in it. So an increasing number of individual DST programs are now internally diversified with multiple properties as opposed to a single asset.
So we're looking at, and you just talked about the one with multiple states. So if something to be aware of, and the sponsors you work with are aware of this, when you've got assets in different states, even if it's a single DST with assets in, let's say, 3 or 4 states, now you've got 3 or 4 different tax returns that
Right.
have to be filed too. So just be aware of that when you're looking at geographical diversification, whether it's a single offering or multiple, that your tax people may be a little busier with some of these, but
Yes.
we've had this discussion over the years, and so I know what you've got out there.
We think, obviously you can become too diversified, but I simply call that additional tax filing, or the additional expense incumbent in tax filing at the end of the year. That's the price of safety, and that's a decision you have to make for yourself as an investor. Is this additional expense and or inconvenience of organizing these materials worth the additional safety I may be deriving from a more diversified asset group?
So if somebody's got something, right now, right here, for example, we've got all these different state rules that are applying, and the state tax rates are, high property tax, since we don't have sales tax and so on and so forth. But if they want to go and diversify, they're able to talk to you, not only decide they want to diversify between asset classes, But asset classes, geographic location, loan to value, a variety of different.
A variety of things, yes.
Yeah. So you sort of figure it out. So if somebody's buying this, we won't talk about returns because we can't.
Yeah.
But as far as what somebody can expect, I mean, when they exchange into one of your offerings, this question comes up. Does it give me all the, the bundle of rights of real estate, for example? You're going to have some interest if you've got a leveraged investment that you can deduct. How about depreciation? You're going to have that also as normal, right?
Correct.
So you're going to have a cash flow component. And is there a potential for a pop at the end of the investment life of this thing? Potential. I'm not saying will there be. Does somebody have a potential to have an increase in equity at the end beyond what the pay down of the loan might be in the cash flow?
Yes, they do. It's in that way. It's no different than any other rental property you have owned exclusively. Assuming we can keep it tenanted and cash flowing, you're going to get a monthly rental income check, as David just mentioned, at year end because of depreciation, and if the property is encumbered by a loan, interest expense, that cash flow is going to be very tax sheltered. And because Section 1031 of the Internal Revenue Code is very, very specific that there can be no participation on the part of the property syndicator manager of any gain or loss at time of sale. Any gain or loss that property has experienced during the investment interval is shared out to investors on a pro rata basis. So assuming we know what the hell we're doing and we pick a property that more people are moving towards rather than away from, and the value goes up, investors may indeed see an increase in equity at time of sale. But the reverse is, let me qualify that and say the reverse is also true. If you pick it's real estate, it's situationally specific. If you pick a property that isn't experiencing positive demographic trends, or other externalities come to work on it, you may end up with less. But yes.
So once again, if we look at a tenancy in common offering, typically they're value add. They're banking on something that's going to trigger a gain over the life of the investment, where the DST offerings are stabilized assets. And as far as the sponsors are concerned, they're making something when they sell it. But I know that some of your sponsors actually, with their primary business, really management. Right?
Yeah.
So what percentage of that DST space is sort of structured that way? Are most sponsors having management done outside, or most of them captive management?
It's there's a split, and the bigger DST property syndicators, the bigger companies that have the experience and the resources, will manage those properties internally. And we think that's a good thing. We think that's something you as an investor want, because that puts the investor and the property management on the same side of the table, because Section 1031 of the Internal Revenue Code is very specific that at time of sale, there can be no control on investor funds by the property syndicator manager. So you're free to do whatever you want at time of sale. That being said, because property providers are building a stream of management income for themselves, they're incentivized to do the best possible job for you. So when it comes time and that property is sold, you turn around and say, hey guys, that was one of the best real estate ownership experiences I've ever had. Let's do it again. So we think internal management is a good thing, while outsourcing management, if circumstances become very straitened like they were in 2008, you can see conflicts develop between management capitalism and investor capitalism, with management putting their capitalism in front of investors having little recourse. And that's a bad thing. So most of the bigger syndicators in the DST space do manage properties internally, and that's something an investor probably should look for.
So I want to just stress what Bob was talking about, your ability to exchange in and ultimately exchange out of these things. If we look at a lot of institutional stuff, if you go to your Wall Street advisor, want to buy real estate, they're going to sell you a REIT. You can't exchange into a REIT except through something called an UPREIT, which Bob's got access to some of those offerings. Also, be aware that if some of the components of tax reform were to actually occur, that would sort of torpedo that entire side. But if you've got joint ownership, for example, this building, if the group of us own this thing, we typically would own it as an LLC. I mean, the lending itself a lot of times would not allow tenancy in common, which 1031 would allow. So we have to go through the whole drop and swap and drop, all that garbage, which is the second biggest headache I've got in my life. Yeah, it's just a real problem. But I want to stress that the DST is sort of a tool that's going to allow you to get in and get out of fractionally owned real estate, whether it's a single asset or multi-asset transaction. The biggest objection that I see with people is just the hold periods. What's a typical hold on these?
The average hold period over the last 21 years has been a bit over 6 years. Every DST PPM private placement memorandum, which is the big book that comes with every deal.
Read every line of that book.
Right. Too. Is going to have stamped all over it, warning this is illiquid and investors should be prepared to hold it for 10 years. That being said, there is no specific sell-by date on any DST property or program. The sale of the property is always going to be determined by management. They have that prerogative. They do not have to consult investors with regard to that. And it is going to be opportunistic based on market conditions. Management is tasked with providing investors with the best possible total return, which, as we all know in real estate, is as much art as it is science. Okay, so they're going to sell that property when they think it is in the investor's best interest, and historically that's been a little over 6 years.
So if you watch my videos, you've probably heard me say this before, but it's sort of entertaining to me at times, because when I have clients that are complaining about that, I say 5 to 7 year hold that you might have, what happens when an investment's short cycled? The same people are upset that now they've got to go find something else, so you can't make them happy, right?
No, it's supremely ironic thing of DST is most people, because you're selling something that you've owned and managed yourself forever and a day. Yeah. So you're going from the known to the unknown, and you're giving up your power over the unknown. So everybody's freaked out, and so the first and most frequently asked question is, how do I get out of this? And the answer is, well, you don't. Don't go into it unless you're willing to go the course with it, because if you try to sell your interest separate from the whole, you're going to do yourself a disservice. That being said, when a property does go full cycle, meaning is sold for investors, and it's been a successful experience, it's the last thing most investors want to have happen, because they become comfortable with the property, they're confident in the cash flow, and they don't want it to change. Yeah. So they go from how do I get out of it to why can't I stay in it?
Which leads me to your ability to put their money to work and get it producing. You've got, like you said, every time you've got product available all the time. So if somebody gives something up, what if they come to you? What's the shortest period of time it might take them to get from initial contact into a given investment?
The closing of DST properties happens very, very quickly. Much more quickly than a normal piece of dirt you would buy yourself, because once you decide on a specific DST program, all you have to do is complete the subscription documents and broker-dealer documents, have them reviewed and approved, and then it goes to the property provider, which then reaches out to the qualified intermediary, Mr. Moore, and within 4 or 5 business days, you are going to be closed and cash flowing on that invested equity. So most of the time put into the process is in coming up to speed in terms of what the product is, how it works, and then you as an investor deciding what property types you're comfortable with and where you want to be geographically.
So as far as when they come to you, number one, we haven't really talked about it today, but they've got to be an accredited investor. But one of the reasons you can get that thing done so quickly is they're not having to apply for the loans. It's non-recourse. They have nothing to do with that. Right. So as far as somebody coming into you, what do they need to give you in order to get the process started? I mean, how do you get this ball rolling?
Whenever possible, we like to meet people personally, and I know I'm old school and archaic that way. And God bless David Moore. He drug us kicking and screaming into the digital age, and that's why we're doing what we're doing right now, because it's the first stop for most people now from an information standpoint. But because of the illiquid nature of commercial real estate, we're going to have a long-term relationship with people. And so whenever possible, we want to meet people, and we want to find out something about them in terms of who they are, what they're comfortable with, and what they're not comfortable with. Because I don't think it's possible to make a prudent recommendation to people until you know them or know something about them personally in terms of who they are, what they are, and what they're comfortable with. So the first step is always creating a relationship. And once we're confident that that's in place, then we move on to product education and more specifically product.
Right. Well, thank you for joining us today. It's been a pleasure as always, educational. And I just want to wrap up by saying David Moore, Equity Advantage, 1031exchange.com, and I love real estate. And Mr. Smith, you've got some words to say to the group?
Yeah, peregrineprivatecapital.com. Go to our website, homepage. There's a Learn button, and drop down to our blogs. And I think we write creatively, entertainingly. You may not always agree with what we have to say, but it is pretty darn informative, and I think we've got a pretty good track record of calling changes in terms of the environment. So please, would love to have you reach out to us that way.
Thank you very much for being here. It's been a pleasure.
Thanks for tolerating me, buddy.
Okay. Take care.
Okay.
Thank you, everyone. Bye-bye.
Thank you. Bye-bye.